This coming Wednesday, we have the FOMC press conference, and this could be a big meeting that we have coming up ahead. So, the FOMC will release their quarterly SEP, or Summary of Economic Projections, outlining their predictions for where they think the economy will be heading in the future, and that includes the Fed funds rate as well. But before we get into that, let's cover a couple of headline topics that have been circulating leading up to this meeting and see if some of these topics are legitimate or if they're just FUD made up by the media. Hey everyone, it's Jonathan here, and let's get right into it. So we're first going to start off with jobs data, and with that data, we're going to talk mostly about the jobs report that we just got at the beginning of the month. For the month of May, we had a strong headline number of 339 jobs added. But even with that strong jobs number, we did get a pretty significant rise in the unemployment rate, moving up about 30 basis points to 3.7%, which is one of the bigger moves we've seen ever since this inflation and wage price spiral concern started in 2021. And given the fact that that report goes on to state that there's really no change to the labor force participation rate, that is a good sign that we are starting to see some tightness in the job market overall. Because think about it, the unemployment rate only accounts for people who are actively looking for a job or who are actively working in the workforce. So if the labor force participation rate stays steady, but the unemployment rate starts to rise, that means that there is more softness in labor markets, which in turn means that there's actual real job losses. But then when we look by the sector breakdown of how the jobs market is moving, we are starting to notice that there's significantly less dominance in the leisure and hospitality sector in terms of jobs gained. And only 3 sectors, professional and business services, government, and healthcare, gained more jobs in the month of May than leisure and hospitality did. And this is really significant because at the beginning of the year, if you remember, we did have significant gains in the leisure and hospitality sector in terms of job growth. So it is a good thing that we are seeing it start to slow down, because that may be a sign that overall economic activity is slowing down. People aren't going to bars and restaurants and hotels and traveling on airlines as much as they did earlier this year, and hence less job growth. Another significant thing we got out of the jobs report too is the average hourly earnings. It rose about 0.3% month over month for May, or about 3.6% if we were to annualize that, which is just multiplying it by 12. And this is a lot more in line with the wage increases we saw before we started seeing inflation elevate in 2021. It is a good sign that that hourly earnings are starting to move back into that direction of being in a more normal state. Hence, kind of building the case more for seeing the Fed pause in the June meeting. But again, let's save that for the end. Let's talk about some other things that we're looking at as well. So when we look at the inflation data, the jobs data kind of drives the inflation data. When we look at the CPI numbers, we've seen a continuing downtrend in inflation over the past year or so with the year-over-year numbers. And even though that trend has started to slow down, it is still moving in the downwards direction, which is a good sign in terms of getting inflation down overall. And if we look at the April report, we see more consistent downtrend in shelter inflation. And you have to remember, shelter inflation was a major player in a lot of the inflation we've seen over the past about 5 or 6 inflation reports. And it was widely believed that this is really what's causing inflation to be driven upwards. But it was also expected that we would see shelter inflation start to fall, especially all of the private sector data that we're getting, that rents are starting to fall and rents aren't growing at the pace that they used to in certain markets. So this isn't too much of a shock, but we're just finally happy to see it reflect on the CPI report. And I think something really important to note when it comes to inflation that I think gets mistaken a lot of times is that a lot of people think that, oh, well, inflation hasn't gone away. My burger that cost $10 back in 2019 still costs $12 now. Well, here's how inflation works. Inflation is the rate of change of the price, not necessarily the rate of change of the price of a certain item, not necessarily the price that the item's at. So if you look at like 2019, a burger was $10. Then in 2021, that burger was $12. Then in 2020, 2023, let's just say that burger is now $12. Well, from 2022 to 2023, there was literally no change in the price of your burger, which hence means no inflation. But if you look at 2019 to 2022, yes, there was an increase of 20% in the cost of your burger. But the Fed doesn't really care about that so much. They care more about what's going to happen in the future. So that's just something good to keep in mind when you do see inflation data and you hear people talk about it on like CNBC or YouTube or whatever, that it's really more about the rate of which prices are changing. So moving on to PPI report as well, we are still seeing services drive the inflation that we are still seeing. And goods are really starting to take a back seat, and in some cases even starting to disinflate, at least on a month-over-month basis. And in the April report, about 80% of the PPI inflation was due mostly to service inflation, not necessarily goods inflation. And this was mostly concentrated in food, alcohol, and hotels. Again, that's sort of the same thing we've been seeing for the past couple of months. I just figured it was probably good to mention it. But even those numbers as well are starting to come down too. So we are still heading into the path that we want to head down. And we are still seeing a continuous slowing down of PPI inflation as well, in the same case of CPI inflation on a year-over-year basis. And in my opinion, I think that the year-over-year numbers are actually way more important than the month-over-month numbers. Because in my opinion, I think that's what the Fed really is targeting, a year-over-year 2% target for the longer run. And they don't necessarily have to meet that 2% goal before they stop hiking rates or even maybe start cutting rates. They just want to see the economy head into that direction and have very solid proof that the economy is heading to that direction. For the next FOMC meeting that we're going to have on Wednesday, we are going to get a summary of economic projections with that meeting as well. And in May, the SEP had a median federal funds rate target for the end of the year at 5.1%. Is no different than the one that they had than the previous SEP in December. Currently, right now, rates are at 5.25%, indicating that we may see one rate cut by the end of the year. But also on the SEP, the Fed funds rate was revised up 0.25% for the end of 2024 prediction, and the range of data was also up 0.25% too from the December SEP. This is something that I'm going to be very watchful of, is the SEP. I think that's really going to be the main driver in this next FOMC meeting, at least in terms of how the market reacts to it. So I think, and the real big question for this meeting is, will the FOMC either hike, pause, or pause for this meeting and hike in the next one? And personally, I think the idea of the Fed pausing in this meeting and then hiking the July meeting is absolute bullshit. I do not think that will happen at all. Jay Powell has been very clear in previous FOMC press conferences that this Fed doesn't want to make the same mistakes that the Fed did in the 70s. And one of those mistakes was prematurely pausing. And honestly, in my opinion, I think that this is just pure nonsense that's being made up in with Wall Street and the suits and the media overall. Why? I just don't understand why the Fed would just pause hiking. It makes no sense. They're going to go or they're going to stop. There's no in between there. So we've already canceled out the pause and hike ideal. So let's just focus on the hike or the pause. And in my opinion, I think it's all going to depend on CPI and PPI reports. So you have to remember that we actually have a weird situation where both CPI and PPI are going to come out the first and second day of the FOMC meeting on Tuesday and Wednesday respectively. So that may have significant influence on what the Fed decides to do in terms of not only the SEP, but also the rate decision for that meeting. And this could be very entertaining because we may see another Nikki leak situation where the Federal Reserve might leak something out to the press right before their press conference or right before they come out with their SEP and their rate decision to kind of steer the market in the same direction as what they plan to do. It's a little bit of a weird game where the Fed doesn't want people to know, but then they want the market to react a certain way, so they kind of need the market to kind of push itself into one direction. So it'll be those couple of days leading up to the rate decision will be very interesting. So like I said, we are getting a new SEP at this meeting. And I really think that the most important thing we want to look at the SEP is the dot plot for where the FOMC members think that rates are going to be at. We also want to look at the range of that data, kind of are they skewing more to the higher end of the peak rate? Are they skewing more to the bottom end of the peak rate? Just something like that. And we also wanted to see kind of where they're at and what they think is going to happen before the end of this year and also the end of 2024. And that'll kind of give us a good gauge to see, is the market right that the Fed may have to start cutting rates soon, or does the Fed think that they still have time to continue to keep rates higher for longer, as they've been saying for a very long time? Another thing I'm going to look for with the SEP as well is to see if the GDP expectations have changed. And this will pretty much be just a really good indication of if the Fed believes that we will go through a recession or not. Now, of course, the Fed obviously doesn't want us to go through a recession. They want to be right. They want to tame inflation with no recession. So obviously their data may be skewed more to avoiding a recession, but this will still be very interesting to have a peek of what they think is going to happen. Then another thing too I want to look for is the change in the unemployment rate. Does the Fed think that we're still going to have a bit of a unemployment rate on more of the higher 4% range? I believe their prediction by the end of the year was 4.8%. And their long-term goal is to get to 4%. Or do they think that their unemployment expectations are going to go down? That'll be something very important to watch out for as well. So I'm excited for this week. I don't know if you are, but this should be very interesting and very entertaining if you're into this kind of stuff. And also, if you're into this kind of stuff, please hit the subscribe button. We're trying to grow here. We're trying to post more videos, keep you guys informed. So if this stuff interests you, personal finance, markets, real estate, stocks, please hit the subscribe button down below. And thank you so much for watching, and I'll see you in the next video. Peace.